There we go. It was all just waiting for that to happen. So,
Yep.
Brilliant. We'll start again. Welcome everybody. I think we've spoken about use of the camera and things like that. I know that Toby has done some introductions with you. I know very little about your organisations. So I suppose I better just describe a little bit what I was aiming to do with today's training. I would anticipate that some people here are reasonably adept at at dealing with finances. Other people, maybe this is right at the very start of your understanding of managing finances. I've tried to cover both things, so please, if some of the stuff at the beginning is quite simplistic, please, those people with a lot of experience don't think, oh, this is at too low a level. At the same time, I'm not aiming at any point to leave people floundering and uncertain of what we're talking about. And I think one of the biggest problems that we have with finance is that it's quite often it seems like a completely alien language. There are words that are used, and sometimes they're used in in normal speech in a completely different context. And I think one of the really most useful things to do to begin with is to actually start looking at some of the terminology that we use in finance, and use that as a way of, I suppose, exploring the concepts behind it. So that's where we're going to start off first this morning. We're then going to start looking at systems and ways of producing financial information, which will feed into, there are almost two sets of financial techniques that we use in organizations, two sets of information. One tends to feed through our accountants, if we have accountants, and produces the annual reports at the end of the year. And there's a lot you can gain from looking at annual accounts. Okay, and what I'd like to get you to the stage is that you can actually look at a set of annual accounts, go through it and say, actually, I know what's going on here in this organization from the numbers. Okay, and then this afternoon, what we're going to look more at are perhaps operationally sometimes the more useful things, the things that you will actually alert you to problems in real time and allow you to take control of them, what we call management accounts. So that's I suppose the overall structure of today. If I start to screen share now, here we go. So are you now able to see the screen?
Yes, that's great. Thanks, Lee.
Okay. And we should have a slide on the screen which asks the question, what is money and what is it for? And I think sometimes this is a question worth asking ourselves, because we all use money. We sort of take it for granted that it's there, but what does it actually do? Okay, and it does a variety of different things. We can use it to exchange. We can use it as a store of resources and as a promise, a means of deferred payment. One of the key things about money is it allows us to compare things which are unalike. So rather than bartering or swapping things, we can actually take completely different concepts and swap them for this common concept of money. And that's all really money is. It's a means of exchanging things, of storing resources up, a means of agreeing things, and a means of converting values of things that are completely different to each other. So for example, the cost of housing compared to the cost of employment. Okay, so we can put different concepts into the values of money. Now, when we start to not printing money, and when we start writing about money, there are some conventions. And again, this is one of the things that occasionally confuses people. So we are starting really at the beginning. When we see numbers written down, we may or we may not actually have the currency sign in front of it. In general, when we're looking at finances, if they're large sums, we may even say that 500 actually represents 500,000. Okay, and so we may miss off some of the zeros. We may certainly miss off some of the decimal points, depending on the size of the organization. And you would normally, if you're looking at a set of accounts, that would normally be written at the top. So it would explain to you whether or not noughts, zeros have been missed off. Also, when we are describing negative values of money, we may see the traditional, as we do in maths at school, we have a minus sign in front of it, but sometimes we just print it in red. And this is, again, people I'm sure have heard the phrase, when people go in overdrawn, they're going into the red. So we have red is an indicator that there's a negative value, sometimes with the minus sign as well. And then the other one, which is, I think, specific really to accounting and is a bit less intuitive, is we'll put negative figures in brackets. So this is very, very, very much for some people who've done lots of finance training. Yes, this is, but for a lot of people who are coming to managing finances and looking at figures for the first time, I think this is a useful thing to know. So figures in brackets generally mean that this is a debt. This is a negative number. Okay. I just want you to pause and think in your organization about everything that you have, all the systems that involve money. Okay. And I don't know if anybody wants to unmute and maybe suggest a few things. You know, you could start off maybe with how many people actually employ staff? Do you have payroll? Okay. How many people maybe actually trade? You may actually have a shop that raises funds. How many organizations put in funding applications? Okay. How many organizations actually buy things, buy resources for clients? When we start to look at the range of financial tools in organizations, it's absolutely vast. We have accounts which are produced by the accountants, maybe by the treasurer. There may be things that you do as managers that actually produce forecasts, maybe forecasts for your income. And I would really, I hope where we get towards the end of the training is that you're, if you aren't already forecasting your income, you're actually thinking, well, I need to maybe put things in place so that we can take control of the financial planning cycle and actually be predicting what we're going to bring in, so we can actually cut our cloth accordingly. You may have budgets, and when we have budgets, again, depending on the size of the organization, you may have an overall budget for the organization. And then maybe if you've got a project which is funded maybe by the lottery fund or something like that, that may have a separate budget that sits within your big budget. Okay. You may have budgets for different functions or different departments. If you have maybe more than one branch, then you might have a budget for the Ealing branch, and then a budget for a branch down the road somewhere. You may have, you may decide instead that you're going to have budgets which are based on maybe housing provision, and then maybe a marketing budget. So you can have functional budgets, budgets that relate to, and it all gets really quite complicated. And then if you're doing any form of trading, you may have to be taking into account VAT. It may be that you've got to issue invoices, receipts, overheads have got to be taken into account. We'll look at what overheads are later. Just loads and loads and loads of stuff. You may even handle petty cash. So you may have to have separate systems to account for that. Just lots and lots and lots of different systems. And basically what they're doing is they are allowing you to measure things going into the organization, things going out of the organization, and allow you to predict, control, and measure to a certain extent your effectiveness. So let's welcome Ian. Ian's just joined the meeting. Let's move on to some of these key concepts. Assets. Very, very simply, and again, it's very difficult. I normally throw this open to you. Very, very simply, assets are things that the organization has. Okay. Now, those assets, they could be money in the bank, or it could be tables, it could be computers, it could be soft furnishings, it could be anything. Assets are things that the organization owns, building and property. Liabilities are things that the organization owes. They could be debts. It could be that they are things which are due in the future. So maybe if a contract's been signed. So assets and liabilities are two key terms. Assets are what you have, okay, or what is potentially what is due to come to you, and liabilities are what you don't have, what you owe. And that links into our next things. We talk frequently about cash, and cash generally is something that we can use very quickly in finance. So if we have cash, we can convert that into another thing. We can use it to buy things very quickly. If we have an investment, if we have something, maybe let's say we have a van or a vehicle, then that has a value. It's an asset, but it isn't an asset that we can readily swap for something else. We need to sell the van before we can then take the cash and then use that to buy maybe a better van or a different van. Does that all make sense? Yeah. When we are looking at doing our accounts, there are two key concepts really. One is that your cash is important. Okay, what you've got in the bank is important, but also something called accruals. And when we tend to prepare accounts, what we tend to want to do is not get taken by surprise. Okay, when you've got a set of figures in front of you, you can look at that and you can say, well, you know what, we've got £100 in the bank, okay, and I want to spend £50 on such and such a thing, you know, maybe food packages. But what you haven't actually taken into account there is the fact that you have already spent £100 on food packages earlier in the month. Yeah. And actually that means you don't really have £100 to spend. Does that all make sense? Yeah. And one of the basics of when we're actually putting together accounts is it's a really, really good idea. They call it the accrual basis, is that when you actually commit to a purchase, that's when it gets recorded in your accounts, rather than when the money actually leaves your bank account. So then when you look at the accounts, you can actually see, actually, we don't have that money to spend because it's already committed. Okay. And I'm putting that very, very simply. So we have a cash basis and accrual basis. when organizations get going in the very early days and your bank balance is really low, it can make sense to be focused on how much you've actually got in the bank, when you're going to go overdrawn, but you can't take your eye off accruals. And most organizations, once they get a little bit of stability, will record their finances at the point at which a debt is incurred or a payment is committed to you. Does that all make sense? Yeah. So cash and accruals is a concept. Turnover, very simply, is what you the money that comes in, okay, before you've actually paid for everything. Okay, you can have a lot of money coming into your organization from donors and things like that. Your surplus is what is basically left over after your expenses. Okay, and lots of organizations can look at themselves out in the commercial world. There's an old saying that you know, turnover is vanity and profit is sanity, because people say, oh, we're trading, we're being very, very busy, but actually they're not making any profit. Well, as a charity, you aren't necessarily after making a profit, are you? Okay, what you want to do is make sure that you're not making a loss. Okay? And ideally you would be making a surplus. And this is again one of the steps that organizations, as they mature and as they become more stable, they will start to actually cover their costs, and hopefully they'll be starting to put some money aside in case there's a problem, and that increases the stability, the resilience of your organization. And we would be calling those reserves. Okay, so turnover, fixed assets are things like your van, things that you can't get rid of easily. Okay. A van or anything like that, a long-term piece of equipment is going to have a value. You might buy a van or a vehicle or a car for, let's say, £8,000. Okay, it might have then a useful life to you of maybe 10 years. Okay, and you might decide, okay, we're going to run this van into the ground. After 10 years, this van, we're just going to send it off for scrap. It'll have a scrap value at the end of that. Okay. At the moment when you buy that van is worth £8,000. That's an asset. But 2 years later, it's not worth £8,000, is it? Because that van has had wear and tear. Its value is decreased because of its age. And so this is another concept with finances that you'll hear the word used, depreciation. Depreciation is where you take the value of a fixed asset, of an asset, of a long-term asset, and you say, okay, we will record this with a given value. It's £8,000. Let's say it's 10 years. Okay, so every year we're going to deduct from the value of that asset 10%. Okay, and then at the end of that time, it effectively has no value. Okay, so when you hear depreciation used, that's what it means. And again, it is an important thing when you start particularly looking at financial accounts. It has less bearing on your actual day-to-day accounts, but on your end-of-year accounts, that's an important word to understand. Capital and revenue. Again, these are words that are used quite a lot. In general, particularly when we're looking at funders, capital doesn't just refer to buildings. It's anything which is probably on that longer term life cycle. So basically, it has a value. It's an investment which is going to last you a number of years, Revenue is stuff that's coming in and going out, normally over a 1 year period. Okay, so things like wages versus property, okay, or vehicles. And again, when you look at fundraising, certain funders prefer capital projects, certain funders prefer revenue projects. Restricted and unrestricted funds. I have worked with so many charities that have struggled over the years with actually fully separating restricted and unrestricted funds. Okay, restricted funds are for a particular purpose. Okay, and this is very much this is more a charity-based term. Restricted funds are for a specific purpose. They would generally be shown as separate. They normally have a separate budget. If you start spending restricted funds on something else, then you can end up turning around to a funder who's given you money for a certain project and you haven't delivered it, and they're potentially in their rights to ask for that money back. So restricted funding is funding for a specific purpose, maybe a lottery grant or something like that. Unrestricted funding, classically, they're the things that you can spend on anything you like. So maybe it's money that you've raised at an event. Okay, maybe it's money that has been gifted to you in a legacy, or maybe it's money that somebody has actually donated through a corporate appeal. So we have restricted funds and we have unrestricted funds. The balance between these is quite important. The more unrestricted funds you have, the more flexibility you have as an organization. Okay, and so we need to make sure that we aren't putting loads and loads of funding applications in for restricted funds, and then we find out that actually we've got very little room to have any flexibility to deal with any crises or anything like that. So the balance of restricted and unrestricted becomes quite important. I hope you're all bearing with this. I do want to get these words defined, because we will use words like this: cost centers. Okay, cost centers are generally, they're the labels and that we give. And when you as an organization, if you have budgets or if you're putting together a budget, you need to allocate what you're actually going to measure costs as. So are we going to measure salary, national insurance? Are we going to measure vehicle costs? Are we going to measure that all our vehicles or per vehicle? Okay, so there are some decisions to be made here, but actually working out what your cost centers are. And then when we look later on at doing some budgeting ourselves, some costs behave in different ways. When you take out a mobile phone contract, for example, there might be a fixed monthly fee. Okay, but then if you go over a certain number of minutes, then it starts basically to actually charge you more. So basically it's fixed for a period, and then above a certain amount things go up. Traditionally a telephone bill might have a standing charge, okay, and then you've actually got your usage charge. So costs behave in different ways. Sometimes costs are steady, and then one more sort of like activity, one more person walking through the door, and you need to bring in an extra member of staff, and so costs suddenly jump. Okay, so understanding that. Another concept is apportionment, and that's where we can actually say that it's actually really difficult to split up some costs. If you've got a building, and in that building you've got people doing marketing and you've got people doing finance, and you want two separate budgets for marketing and finance, but they're all sharing the same electricity bill. Well, you could, I suppose, go and start timing how often people have the lighting on and how often people have the heating on and stuff like that. But much easier is just to split it across. And we can do that on various bases. We can split shared costs on the base. We can maybe use square footage or things like that. But in general, this splitting of general support costs, allocation of these different costs across different functions, sites, departments, whatever, that's a useful thing, okay? But you always need some form of basis for doing it, okay? Talks about fixed assets and depreciation. Does anybody here trade? Does anybody here have like a charity shop or anything like that? Once you get into trading, then there's a whole extra set of financial considerations. Certain items might so like bring in VAT. You might have you might have sort of like various other charges which come into place. Also, if you're undertaking contracted pieces of work rather than grant funding, there may be tax implications, okay? And also trading funding in general is very useful because it can be basically said to be unrestricted. You can spend it on anything you want. It can generate a surplus. And this is what we really want. Instead of profit, we want to build up reserves as an organization, because reserves, we don't want massive reserves, but what we do want is we want enough to see us through a crisis. You know, if suddenly a major donor pulled out on us, okay, reserves help us to actually weather those storms, okay. Generally, I like organizations to have at least 3, possibly 6 months worth of reserves. I think it's good practice. It can be very difficult for small organizations to get to that point. Really difficult, but it's well worth making that part of your strategy, because it means a problem arises, you may not have to actually lay off members of staff. You may not have to let down service users. Now, a lot of organizations, bigger organizations, particularly with property, may have what looks like very big reserves, okay? Because some of those reserves are held in the value of property, which in general, particularly in London, are quite large numbers, okay? But free reserves is also an important. What could you actually readily convert to deal with a crisis? So reserves and free reserves. You'll hear these words occasionally: gearing and leverage. That basically relates to how much you have borrowed as an organization and how much you might owe. I'll not go into much more detail than that, but there is, as I think, as we all know, there's been a lot of money, particularly for social enterprise, but basically to develop and to capacity build, loans have been offered to organizations, and we need to be careful. Normally borrowed money we would use for growth, okay, but too high an amount of borrowing could basically again leave you vulnerable as an organization. And if you notice the way that I suppose when I first started giving some of these definitions out, it was very much, this is to do with accounts and writing things down, and now it's like we're moving more towards, this is what leaves you vulnerable, or this is what makes you robust as an organization, okay? And I think that is probably as big a concept to get your head around as any of these words. The words will help you understand as we go through stuff, but actually understanding this stuff makes you more resilient as an organization, okay? It allows you to spot problems before they actually arise. So liquidity and insolvency. This free reserve stuff, this basically liquidity is how soon or how much money have you got which you could rapidly, how many assets have you got which you could rapidly turn into something that you could use to rescue your organization or use to spend on something else.
Hi, Jess. How are you? I'm fine, thank you.
Hi, Jenny. If you do not have enough money to meet your debts,
All of it?
then we would say that you are insolvent. Okay,
Oh,
you're not liquid enough. Your assets aren't liquid enough to meet the sort of like debts that you've got coming up. And when an organization reaches that point, it can actually be illegal to continue operating as an organization if you can't actually meet expenses. What insolvency would be, liquidation is when all the fixed assets are liquidated and are used to pay off people who are owed money. And that does unfortunately happen to organizations. And it's something that we need to be aware of. We want to become robust organizations that can deal with problems. I'm just going to pause a bit there because I've been talking quite a bit and it's just been lots of words on the screen. Okay. And I hope it didn't send you to sleep, but I do think there are some very, very important concepts within those words. Okay. And for some people, a lot of these words just fly past and the meanings, you just get used to hearing words. Accounts is one of those words. Financial accounts, there tends to be difference between financial accounts and management accounts. If we look at financial accounts, they tend to be the sorts of things that are prepared by your accountants. It's what we would submit to the Charity Commission and Companies House at the end of the year. It looks backwards.
Hi, Lee. Sorry, can I just stop you there? Can people please mute their speakers?
Yeah, the host can mute speakers as well. So Lee,
I think
you can mute Jenny.
Is it Jenny?
sorry.
Yeah, if you mute her.
Sorry.
There we go, Jenny. Is that okay? Brilliant. So financial accounts tend to look backwards. They're a report. What they're about is they're about demonstrating to other people that you have managed your organization well up to that point. Okay. There's a role for it to do with compliance of standards and legislation. Users, tax office, auditors, investors, customers. You know what? Yes, it might be the Charity Commission. It might be Companies House. I actually find that funders and donors will be checking your annual accounts quite often before making some form of award to you. Any form of investments, any form of donors. You'll also find that potential employees nowadays as well. Your accounts as a charity are openly accessible. Anybody can download them from Companies House. And the impression that you give with your accounts gives a lot of information to a potential employee. And obviously, as organisations, we exist on the skills of our staff. As a small organisation, you may just be submitting very, very simple accounts. And we'll look at some simple financial accounts in a little while. Okay. You might be submitting very simple accounts. Once you get to any size, certainly once you've got payroll, really, I think an accountant is an essential sort of like asset for preparing those. There's a standard format for accounts, which need to be prepared in a certain way. Then once you get even bigger, then it may be that you need to have independently audited accounts as well. Okay. So they're to do with compliance and making sure that you as an organization have exercised due diligence. As a result, it tends to be the trustees of organisations that focus more on the financial accounts. But as I say, employers, funders, employees may very well be looking at those financial accounts. Management accounts, which we'll look at a bit more this afternoon, they deal both with the past, but more often with the future. They can be done not annually, but they can also be done quarterly, monthly, weekly, or even ongoing. Management accounts are really my big interest as sort of like as a manager, because they help you to control organizational objectives, to set and work towards goals, and to monitor progress. Okay. They need to be in a format that is useful, therefore, to managers. There's no point producing management accounts that only suit trustees at high level, but have no relationship whatsoever to the managers who are actually setting the budgets, spending the money, okay, undertaking the activities. So management accounts need to be designed for the people who are actually going to use them. Okay, it's got to be relevant and it's got to be useful. So let's have a look at financial accounts. They're normally prepared for a given financial year. And as organizations, you will have a financial year. Many organizations run from April to April, but you don't need to. Some run from, December to December, January to January, September to August, lots and lots of different ways. And it's what really suits your activities. If you're an education charity based around an academic year, then why not run to the academic year? It doesn't make sense to stop your activities because you're, halfway through your financial year. Okay. Financial accounts provide information about how the charity has been managed. There's normally a summary progress report. So in general, if you're looking at a set of accounts, there'll be a front page. You'll have information about the names of the trustees, who the company secretary is, who's prepared the accounts. You'll then have a summary progress report. And this is a really useful piece of information, particularly for funders, or if you're looking at another organization. And this would normally be written by the trustees, maybe the chair, who would basically give an overview of what their objectives for that year were, what they actually achieved. So in this year, we decided we were going to expand. As a result of that, we took on new premises and 3 new staff. We had difficulties because of coronavirus, which meant that our activities were trimmed back. However, our reserves were adequate to meet the needs of that, and we were unable to continue the expansion, as an example off the top of my head. You'll then have a statement, and this is again another important bit of the financial accounts, a statement of compliance, particularly in terms of risk. Now, in a lot of organizations, that might just be in the accounts, a statement to say, the trustees have undertaken an assessment of risks to the organization. We deem our reserves adequate to deal with any unforeseen circumstances, and procedures have been followed. Okay. I do worry sometimes in organizations that that's all that is, just a statement. I think, depending on your role in your organization, particularly if you're a trustee or if you're sort of like a senior member of staff, a real serious look at potential risks of the organization and an honest look at, do our reserves cover us for these risks? If we don't have any reserves, then we really need to keep an eye on these risks and make sure that we are fleet on our feet, as it were, and we are able to respond before a small problem becomes a major crisis. Okay, so this statement of compliance that comes in financial accounts, again, I think is a really important thing, even though it might just be in one line. There are templates for risk registers, and I'm not going to get into governance and stuff like that, but operational risk, financial risk. There'll then be a statement, normally, if you have an accountant or an independent examiner, then a statement from them to say that the report has been prepared in accordance with whatever size organization you are. Okay. And then we'll have a statement of financial activities, balance sheet, and cash flow statement. Okay. The cash flow statement is about your liquidity. Statement of financial activities would be a breakdown, and some of these, depending on, again, the complexity and the size of your organization, might go into more or less detail, might focus in on certain areas. So if you are if you're a charity that deals with property, it might focus in on the property side. If you're another organization that maybe deals with young people at risk doing youth outreach, then it might deal more with staff and what sort of staff you've employed. Okay, and so that will be designed to give the reader information about the organization's core activities. And then the balance sheet at the end of it is, again, phrase that you'll have heard, the bottom line. Yeah, where they actually stand, what are the assets and what are the liabilities. Does that all make sense? Yeah. So every set of financial accounts, whether you are, whether you're a Premier League football team, or whether you're a little charity, will generally cover the same things, just in more or less detail. Couple of other things we need to bear in mind financially. Charity Commission financial guidance, we need to make sure that we're following that. And again, if people aren't aware, the Charity Commission has a number of documents which give advice and best practice on sort of like financial management. And we do have this duty to consider risk. That's why we have the statement. So these are specific bits of legislation now. There is an audit threshold. Once you get above a certain size, you need as an organisation to be independently audited. And if an accountant's preparing your accounts, they'll produce it in line with the general accounting principles, okay, and the statements of recommended practice. Is anybody here an education linked to an education charity, university, or anything like that? There may be additional legislation there around education. And then this last one is again, I think, a key one, particularly for the smaller organisations, but even big organisations have fallen foul with this. When you are spending money, okay, you can only spend money in accordance with your memorandum and articles, with your constitution, okay? If your constitution allows you to spend money on property, on work with disaffected young people in the London area, and you decide that you are going to suddenly start supporting a project up in Newcastle, then you may actually find that you do not have authority within your constitution to do that, and potentially you would be acting illegally. Okay, so again, something to bear in mind, again, within organizations, is for the people, when you're taking out new projects and things like that, just be making sure that you're still in line with your memorandum and articles, with your core mission. Okay. Now, it may be that you need to, and many organizations do this, is that they expand their ability to spend money within their articles and constitution. But what you don't want to be doing is going out, running projects, spending money on things that you're not allowed to as an organization. Has anybody here ever been audited as a charity? It has happened. It does happen. I was involved many years ago up in Manchester with ESF funding, European Social Funding, linked to Single Regeneration Board, SRB5. It was decided that they were going to audit a number of projects that had received funding. And I got to say, it was a very intense process that took a long period of time. Auditors came in, they wanted to check that their money had been spent, and they literally wanted every bus ticket, every receipt, and they needed to understand, because we were running a number of projects, and that was a project within the charity that we were running. They needed to understand exactly, well, okay, your phone bill, how can you prove that so much was spent on this project and not on another project? And so we had to break everything down in fine detail. And to be honest, that was probably the point at which I thought, you know what, I really need to get my head around this. I need to become good at managing finance. Okay. And the key things are everything needs to be traceable. Having a system whereby you can track any item of expenditure all the way through, from the bus ticket through to the annual accounts, is an important thing, whether that's using petty cash, day books, whether you're using some form of sophisticated, sort of like computer software. These are all really important things, and keeping records, because you never know when somebody might need to see them. Okay, so make sure all your transactions are being recorded. Ensure that there's a trail, receipts are kept, you can show evidence. Don't muddy the water. Things like drawing out cash to spend on items, yeah, or having something on the same receipt. You've gone in, you've been buying food for a project because you're feeding some hungry people, and while you've been buying food for the project, you bought yourself a bottle of Coke, or you bought yourself a few items as well. We can't do that. We need to keep things separate so that it's very, very clear. Particularly cash, because cash it's very fiddly. It's very fiddly to account for, but we really need to keep our eyes on that sort of thing, and having it regularly reconciled. So checking that the receipts match the actual expenditure. That's the term reconciliation. Useful things is you can have a book which you record all the money in, all the money out. And if somebody takes petty cash out of the office, you write down, and then when they come back, you check the receipts, somebody signs for it, and then normally somebody else will sign to say that they've seen somebody sign for it. You may use software. Now, some items of software nowadays are getting really, really good at allowing you to do this in real time. The two main bits of software that are used are Sage and QuickBooks. Okay, Sage traditionally is I would say Sage is very, very flexible, very, very powerful. Both of them have options where you can have a light version, okay, which again is useful when you're operating on a budget. Sage is very good at running payroll, okay. QuickBooks is quite flexible for small charities, and the online version is very good because you can link it through to your accountant, and your accountant can produce reports for you in real time. There's also a number of bits of software out there which you can add on. QuickBooks certainly have one which is a mobile phone application, and the QuickBook mobile phone application will actually it will allow you to press on your phone when you're heading on a work journey, and it will record your mileage. And then when you actually make a piece of expenditure, you can actually take a picture of the receipt and it will record that. It will file it against a transaction in real time, and that'll just go straight into your accounts. And you can basically, you've got a record of that receipt now. Okay. So there is certain applications there. Now, going into those in real depth would become like an advert. So I don't want to go into, I would certainly say that Sage and QuickBooks are your two main options. Okay. And it will depend really on the price in your pocket. And I would also say, if you have an accountant, the system your accountant likes using. That's a really important factor to bear in mind. There's no point, you know, if you're about to get a new accountant and you decide, oh, I'm going to go with QuickBooks, and then the accountant goes, oh yeah, all my other clients use Sage, because then you just create a little bit of problems. It makes it less easy. Okay. If you're very small, then there are homemade solutions. Okay. And it on a very, very basic level, for a really small organization, I'll show you in a little while. I'm going to stop the presentation and we can have a look at a couple of just very, very simple spreadsheets and what they entail, which can enable you to sort of like to do your own thing. That information normally goes up to the accountant or treasurer, and it's used to prepare accounts. I have some links here, which are to QuickBooks and to Sage. Okay, and they are reasonably low cost options. I'm looking at timings and things like that. And these two spreadsheets, I think what I'll do is I'll give you a very, very quick look at them because we have, I know we had the issues getting set up this morning. I do want to actually show you these, but I think this might be something that we actually email out to you so that you can actually look at them, you know, at your leisure, maybe even use them yourselves. So I think what we'll do now is we will just change the screen share. If you just bear with me. Okay. And okay. So just won't be a second now. Okay, so what I'm going to share with you now is a very, very simple bookkeeping system for those who okay, have we got that on screen now? So basically, the simplest of bookkeeping systems would basically be to be recording dates, what you were spending money on, a number on a receipt. So, you know, that could be a check number. It could be a transaction number if it was a bank transaction. It could simply be that you've got a bus ticket or you've got a tube ticket and you've written the number 1 on it because it's the first one on that particular sort of like month or whatever period it is that you're recording. Cash or bank, what it was on. So these here would be your cost centers. Remember I mentioned those earlier? So that could be on parking, could be wages, whatever. And so this might stretch out a long way, and then you would just tally it all up at the end. Okay. We can do that with then receipts, any funding that you receive, and then that would then feed into basically purchases and sales, and ultimately that would go through to a profit and loss system. Now, I think what we'll do, if it's okay with you, Toby, is we want to let people have a lunch. Yeah. And we said we were going to break at 12:30. I'm going to come back to financial accounts very briefly at the start of the afternoon session, and then we'll go into the management style accounts. Is that okay with you?
Yeah, I was just thinking about the timings for the lunch. Obviously, it's a good idea to have a break so we're all fresher. So we can still stick with half an hour if you're going to be okay to do all the rest within the schedule of it. Is that going to be okay?
I think we can do that. Yeah.
Okay.
Would people prefer that? I mean, I do think there's been quite a lot.
There certainly has. There's been a great deal to digest and think about. So I do think it is actually a good idea if everyone else is happy that we do have half an hour and we can still finish. Remind me when we're due to finish.
Was that sorry?
Remind me when we're due to finish. Is it?
I think we'd said 3 o'clock we were aiming for,
yes,
wasn't it?
3 o'clock. Yeah.
Yeah.
Okay, so if we still have a lunch break now for half an hour, and we start at 1 again.
Right, and I will see as well if I can actually get some of this technology working in a bit more of an interactive way. I do apologise. It's been very much me just spouting at you. I hope I've not overblown the given too much. If that makes sense.
Yep. But if I can just remind everyone to not log out. It's just easiest if everyone just closes their screen, but not to log out. It will be easiest for us all to just pick up bang on 1 o'clock. So if everyone can just keep logged in and yeah, just maybe close your screen down and we can all pick up again at 1.
Lovely. Thank you.
All right. See everyone later.
Okay, see everybody later. Bye-bye.
Bye.
Of financial accounts. Now, effectively, I've made up this set of accounts. We've got a fictional charity, Generic Aid, and this is. I just want you to have a little look, familiarise yourself with the way in which accounts are laid out and what they might tell you. So here we go. So what I just want you to do is just think, first of all, what can you gather from their performance? What might have affected them and what issues might they face going forwards? So if we see, and I'll just talk through this here, we have income resources of £150,000. They've also gained some money from rental. Now, we don't know whether that's renting out property or whether they, they're sharing office space with another organisation. They've had some investments, and then they've got other, which is probably, small donations, things like that coming in. So in total, £180,000. Okay. They've also had restricted funds come in under other of 30,000. Okay. Now, if we look this year, 2018 to 2019, we see that they've brought in 21,000, which is less than the previous year. Okay, so this is our first box at the top of the simplified accounts, financial accounts. It's telling us basically what's come in, what was restricted, what's unrestricted, and how they've done to previous years. Has anybody got any thoughts on what that might tell us? Okay. Next thing then, we're going to look down at where they've spent the money. Materials, salaries. Salaries is generally, salaries or property will generally be your biggest expense. Premises, they've spent 20,000 on premises. They're certainly not based in London, are they? Sorry, little joke there. All very similar to previous years, not any restricted funds there. They've spent less money on fundraising than previous years. Spent the same on transport, and their overheads have increased. Okay. And that's been made up of £5,000, sorry, from restricted funds. So overall, unrestricted funds, okay, they've had a balance of 40,000, and restricted funds, okay, that should be 25,000, shouldn't it? Okay. Because they've had 30,000 come in, they've spent 5,000. That's a typo there. Funds carried forward at the end of each year, they're carrying a lot of money forward, 160,000. Current assets, current liabilities, and free reserves, 165. So just look at those things and see if you can spot any potential issues there. Okay, I'm going to stop sharing so I can see the chat there. Anybody have any thoughts on that you'd like to share on the chat? Okay, or even to unmute yourself and to actually say what you thought about any potential issues that organisation might be facing. Okay.
I would like to go there. I would like to, I haven't really thought about so much about unrestricted funds. So in future, I didn't keep account, but I've used it in petty cash. But now it's more clearer what is restricted funds and what is unrestricted funds.
Yes, I think that's a really important thing, and I think if we actually look here,
yeah,
what we're seeing is that they do have a bit of a problem with their sort of like restricted funds, don't they? They've had incoming resources restricted of 30,000,
yeah,
but they've only actually spent 5,000. Okay.
yeah.
Now,
So I think making this spreadsheet enable us it's much easier to pick up how much is a restricted fund we spent and how much we haven't spent, and make it much easier to look into every 4 months that how much we can spend more, what we can look into more.
yeah, and again, I think that's really important when you actually when you look at your finances, you really need to keep your restricted funds separate. It's almost like they use the phrase, don't they, ring fence. There's a big fence around that money because the dangers are that if you actually
we do okay
but if it gets confused, or if you it can be difficult as well, and what can happen is people, they get the money in for a project,
yeah,
and then they almost forget it's there, and it merges with everything else that they're doing,
overspend.
and then at the end of the year, either they've overspent on on unrestricted, and they haven't spent what they should have done on the restricted funds. It's a double-edged sword, really, because if you are not spending money on a project that you've said you're doing, then actually not only could the funder technically, they could ask for that money back, potentially. Yeah. They certainly could, you know, be very loath to fund you in future. But also your activity, you haven't done what you said you were going to do. So you've actually let down beneficiaries as well. So separating those out is important. And I think in this instance, we have an instance where they've only spent £5,000 of their restricted funds, and that's all been on overheads. So basically overheads again are those shared costs. So it looks to me there as if they haven't actually spent any money on that project. They just haven't run it. Does that make sense?
Yeah, much better. It's much clearer now.
Okay, so let's also look at these. Anybody else want to? Flora, were you wanting to say something?
Yes, can I just ask a question? I think it often happens in charities that they may have leftover of restricted fund, which was funded to the organization for a specific project, which we know.
Yeah.
But they may have some of that cash unspent at the end of the year. Is it really the only way to deal with that unspent cash to actually return it back to the funder? I
would certainly say that speak to the funder.
Yes.
The thing is, if you've got that money left over, what it actually means is you haven't delivered.
Can I just say something? The project, let's take a scenario that the project was actually delivered and it was successful. But maybe because of some accounting transactions, they haven't really apportioned the cost properly, because it is very difficult when you receive funds from a funder and you really have to apportion it properly on utilities, on salaries, and all the costs across the organization.
Absolutely. And it may be then that you actually look at it and you say, well, okay, we can, hand on heart. See, this is financial accounts, and the financial accounts will show restricted, unrestricted. It may not separate that out. If your financial account, let's say it was, I don't know, let's say it was the blog's beneficent fund that had actually funded the project, and you had specifically put that in your accounts, but you hadn't apportioned them correctly, then basically accounts are produced in arrears, aren't they? They look backwards, your financial accounts. So what I'd say is go back and apportion it correctly.
Yes.
Yeah.
Sometimes,
because this is a backward looking thing with your financial accounts. Yeah. Your financial account looks backwards. It does need to match ideally what you're saying to your funders, particularly if, you know, if there's only one restricted project, the funder might say, well, you've given me a return, and that return might be correct. You might have apportioned it correctly there. Then I would say, before you submit your financial return to charity, you know, Companies House and Charity Commission websites, then make sure that it matches. And that might be going to your accountants and saying, why didn't we apportion this correctly? And we learn something from that for next time. Does that make sense?
Of course, yes, it does. Yes.
Yeah.
Can I just a very small quick question? At the bottom where you have the balance sheet, current assets less current liabilities, and you show as free reserves.
Right. Yes.
So free reserve is basically your cash. Am I right?
It's the cash and stuff that's easily turnable into cash. So things things at the end of the year, because other reserves might involve, and this particularly happens where we have organizations that own property, that in the financial accounts, the property counts as an asset. So you do get, and you know, I've been in a charity. I ran a housing charity myself, and ended up in a situation when we were in our startup period that we, in the books and in the financial accounts, we were very, very well off because we bought property. And we'd bought property with specific restricted funding. We'd renovated that property. However, we didn't really have any revenue funding. Okay, so that was a big application to reaching communities and the lottery fund, and we got it all going, and everything happened. But we weren't, you know, so technically book value, we look very healthy. But actually, we were very close to being insolvent because we couldn't necessarily, we couldn't have sold that property. It was almost a notional value, and the property market was rock bottom in that area in the north of England. We'd never have sold it. It had covenants on it, so we couldn't actually use it for any other purposes. Does that make sense?
It does. It does. Yeah. Thank you.
Brilliant. That's lovely. Thank you, Flora. Okay.
Lee.
Yeah.
Hi, Lee. This is Vincent here.
Oh, Vincent. Hi, Vincent.
Hi. Lee, thank you. I've just got few questions or probably queries. You know, one is on the restricted fund. Normally, from what I understood, was it's annual, right? The restricted fund has to be used within that annual year, or
it depends. And this is the other thing, that a set of restricted funds might overlap your financial year. And this is something that's quite common. For example, lottery funding may run from the award date. For 2 years. Okay. And they might, so it might be that you've got a budget for year one and a budget for year two. And you can just say, okay, we're a bit late. And so you write a report to the funder and say, we're late spending some of this money. Or it might actually be that for these restricted funds, we don't know. When we look in here, they've only spent 500,000 of it. Restricted funds might have actually only come in a month before their accounts were due.
Okay.
Yeah. So it only tells us a little bit of the story. Does that make sense?
Yeah, clearly makes sense. Yeah.
But certainly if I was looking at these sets of accounts and going, you know, there might be a problem here, I'd certainly be maybe asking that question. If I was another funder, I'd be saying, okay, yeah, these restricted funds, just explain. And if there's a reasonable explanation, then, you know, then absolutely fine. Certainly you would expect that then to show in, you know, in future years. Does that make sense?
Yes, Lee. Thank you for that.
Yeah. Brilliant. Anybody else, any thoughts on this? Okay. A couple of other things that we can use financial accounts for is to do a bit of a health check of an organization. And when you look at your organization, there's things we've already addressed. Is there somebody in the organization who understands finance? Do you have an audit trail? Do you record restricted and unrestricted funding? Do you keep those separate? Yeah. Are you keeping an eye on the finances? You know, and checking that you're spending against actual budget headings, or are the budget headings that, when, you know, again, what happens quite often, particularly in smaller charities, is we put a bid in to funders and they say they want to fund IT equipment. And so we say, okay, we'll have you know, sort of like a computer, we'll have a printer, we'll have this, that, and the other. And then we put another funding application in, and that funder says that they want to fund gym equipment. So, you know, we put a list of, it's almost like we have a wish list. And that's a really good way to approach sometimes fundraising, is to have a wish list of things that you want. But when it actually comes, then are we actually combining that into an overall budget that covers all the funders we have, so that we can track what we're spending, whether it's restricted or unrestricted? So that's part of your financial health check. We can then move on to a couple of others. Now, what I don't want you doing, any of you, is putting your hands up and going, oh, this looks really, really complex and scary. as much as anything, this is just a concept. You'll get the handouts to this, and so you'll be able to go, okay, I can take this, I'm going to show you some formulas. Please don't be scared of mathematical formulas, okay? But when we look at financial accounts, there are a couple of very quick tests. The first one is, and there's various names for this, and there's subtle differences between them. I'm not going to go into this, but it's basically a test of how solvent are you as an organization, okay? And it's basically what you owe divided by what you have. If it's more than one, if you have more than you owe, yeah, and particularly if you're liquid asset, if the things you could, your free reserves, the money you could spend if you needed to, yeah, would that cover all your outgoings? Okay, and generally that should be above, so that should be basically you should have more assets than liabilities. It should be below one, sorry, so it's liabilities over assets. Okay, that's our first indicator. Okay. Can we meet our obligations? The second one is unrestricted and restricted. Now, these are charity specific, and this is all taken from a piece of research. It's one of the biggest research projects ever undertaken in charity finance. It was done a number of years ago. And it put all of this into a big, long formula. So you could do an instant health check like they do in sort of like in banks and things like that, which I think is probably a bit too, it's a bit too complicated, not very helpful, but I think the headings. So are you liquid? Are you solvent as an organization was the last one. This next one is how flexible are you? Yeah. And this is what's the relationship between unrestricted and restricted funding? Okay. If everything is restricted funding, then you don't have a lot of flexibility. Okay. So if, for example, every single thing you have is project based, it's not covering your administrator. Have you worked the overheads in properly? Have you managed to do full cost recovery? Again, when you do your fundraising training, all that sort of stuff will be covered. If you are tied to only spending money on certain things, okay, and this is one of the reasons a lot of organizations have started trading. This is why a lot of organizations run event type fundraising as well as trust and corporate fundraising, is because what they're after is money that will actually, they can spend on what they want and can be used in an emergency. Okay, so how tied up is your money in project and how free is it? Okay. Your equity, okay. What you've got, your revenue, your money coming in and your reserves, yeah. Could it cover your operating costs? Will it cover you this year and a bit of next year? Effectively, do you have reserves that'd work? Okay. Again, very, very hard building up reserves. And this is an interesting one as well. Concentration. How many donors do you have? If you've only got one funder, that can actually put you in a very difficult situation, because if all of a sudden something happens to that funder, you know, this happened to a lot of organizations when, you know, round about 2012, big change of government, big change of emphasis, move towards contracts, payment on results and things like that. And a lot of restructuring of those funders, or it happened, you know, when the Learning and Skills Council changed. Various big changes out there, political changes, maybe a scandal. You know, if you're an organisation involved in overseas sort of like aid, and then we have all the scandals that have been you know, about overseas aid organizations, and suddenly your one big donor pulls out. Yeah. And that suddenly leaves you with a huge problem. It's almost the eggs in a basket thing. Do you want all your eggs in one basket? So again, and this isn't something you can necessarily change overnight, but it's something, particularly if you have influence on the strategic direction of your organization, being able to spread that out. And generally, certainly from my experience in organizations, more than 30% of your income from one donor leaves you very vulnerable. Okay. So concentration, and then surprisingly, your admin ratio. How big are your admin costs? Now, this was, I mentioned this this study. It was nearly 5,000 non-profits, and they looked in depth at their finances, and then they looked and tracked them over a period of years. And they found that the organizations that were disappearing were the ones that were running they were either unsustainable or they were running so lean. They and it's almost counterintuitive, because we all want best value. We don't want to be wasting money, and individual donors in particular, they don't want to be spending money on, you know, they want money to go to the front line. But actually, we do need to recognize that things like management, things like some of the admin costs, they can actually support us by having a more skilled workforce, for example. Yeah. We can maybe respond more creatively to problems. Very cynically as well, I think, and it's something that the original study pointed out, was that it also gives you somebody to sack and still be able to keep going, which, you know, but basically having some slack in that, in admin ratios, actually made organizations more resilient. So I suppose all I'm trying to say there is we need to do best value, but don't run so lean that it means you're forever chasing your tail and you can't deal with crises. Does that make sense as well? Yeah. And then at the end of the day, when you look at the bottom line, are you just balancing every year or making a slight loss? Or are you managing to actually build up some reserves? Okay. The lower those margins are at the end of the year, and margins is one of those words that's used in a number of different contexts in finance. Don't get confused by it. This is sort of like your end of year profit margin. Basically, if you look at the bottom line, is it actually going to do anything, you know, towards building your reserves? Is it going to make you resilient? So does that all make sense?
Yeah.
Yeah,
Lee.
lovely.
Hi, Lee.
Seconds.
Lee, please, could you explain the equity thing again, please? The equity one?
The equity one, just give me a
Yes,
second.
please.
I'm going to have to, yeah, for some reason, you've all disappeared from my screen, but never mind. So equity, what you've actually got, so money coming in plus your reserves, okay, is that less than or more than your operating costs? So basically, do you have enough money to survive the full year? And ideally, that should effectively, because you're including your reserves, mean that at any one point, that if everything, let's say all your funders stopped, yeah, or maybe something like COVID happened, but it meant that all your property had to be empty, you couldn't carry out any activity. Maybe you had a fire at the premises and you were going to have to wait for insurance to cover it. Would you be able to keep your staff employed? Would you be able to relocate somewhere else and keep your service running? So that's basically what the equity part of it is measuring. And ideally, we're looking at basically having your year covered and at least 6 months of another year. So having enough money in hand. Now, again, that's very, very difficult, particularly for small organizations. Okay. But it's something definitely to aspire to make you more resilient. Does that explain?
Thank you, Lee. Thank you so
Lovely.
much.
Okay. I'm going to have to stop screen sharing now just for a second. And I'm going to start up what technically is this afternoon's the second half of the training. But does anybody else have any other comments or questions at this point?
Yeah, I have a question, Lee. If I have a project worth of £20,000, how would I know what percentage of the admin cost should be? How do we work out the admin cost?
Right. So you've got a project. It's £20,000.
Yeah.
Yeah. Now, when you get that money in, some of that you'll have put a budget together to get that money, won't you?
Yeah.
So some of that £20,000, if, for example, that £20,000 was to buy you a vehicle,
yeah,
then really there's no admin costs. You could maybe say that, well, actually, the time that it takes for somebody to go out and choose that vehicle, we're going to cost that in. So that would be a way of doing that, and it would just be the stuff that wasn't spent on the van.
Yeah. Okay.
On the other hand, if you've got, let's say it's a drugs project, drugs education project, and you've got somebody sat at a desk and they're sharing a telephone with somebody else in the same building and the same desk with somebody who's running a sexual health project.
Okay.
Yeah. Now, obviously, there's the expenses dealing with the clients.
Yeah.
Yeah. But then there are these shared costs. Okay. Admin costs and overheads. Okay. Now, admin costs that when I used admin costs previously, what I was on about in those financial accounts and within that ratio was perhaps more, what does it cost for your trustees? What does it cost for your management team? Yeah. When I think what you're asking is apportioning overheads, some of which would be admin costs. Yeah. And some of which would be shared costs as well. Things like the telephone, maybe the heating and the lighting bill. And there's various ways you could do it. Okay. You can do it on throughput, for example. That's one way of doing it. You say, okay, how many young people or how many homeless people is this project working with, and how many hours? How many hours and how many? So we can do it on that basis. You could even do it, particularly if it's an office-based cost, on saying, well, what square foot are they using? So this has got, we've got a big room here. There's maybe 100 square foot, and a quarter of it is used by the drugs project, and 3/4 of it is used by the homeless project. Then you can do the sums that way. Does that make sense?
I would like to learn a bit more on the admin costs and the budgeting as well. So
that's where we're going now.
Oh, wonderful. Thank you.
So thank Flora.
Yes, a very quick question. If you have a major building expenditure, for example, the ceiling has come down and you have to repair the ceiling or the roof, and it's a major building work, it's costing the organization a lot of money.
Yeah.
But your unrestricted fund is not enough to fund, to cover the cost. Therefore, you have to dip into your restricted fund. Is it possible? How do you do it?
Right.
It's an emergency. You have a hole in your roof and it's got to be repaired, but you don't have enough unrestricted.
Now, technically, those funds are restricted. You've made a promise to only spend those on the things that you've said. You could go to the funder and you could say, excuse me, we've had this happen. Yeah. and explain to them. You would potentially be putting your organization at risk if you started robbing Peter to pay Paul. I've had this very recently with an organization that I was giving some support to, a very small organization. And they basically had, they were making a purchase, they were buying a vehicle, and, oh, it's suddenly costing more, but we've committed to it. Oh, we'll use this money from this project then, and we'll fundraise and pay it back. And they never managed to pay it back. Yeah. So there are potential problems. I would say talk to funders. Funders are very understanding, particularly if something like that's happened. It could be then that what you're looking at is you're maybe going specifically to a funder and saying, you know, please, this is an emergency, help us out. But really, unless you know, and this would be something trustees, you know, risk analysis and everything, it would be a big decision to make, to spend money that's promised to something else. Really, you shouldn't do it. Does that make sense? Yeah. And it does become very difficult. I know, particularly when we're running on tight margins with very little reserves, something unexpected happens.
Yeah, the Charity Commission has actually prosecuted the charity for transferring restricted underspend into its unrestricted reserve. So it is,
yeah, absolutely
dangerous.
Absolutely, it'd be very dangerous for the organisation. One of the things that you know, makes it does make it very difficult for organizations running on these tight margins and things like that. But it is just something we need to understand. You know, you've made a promise, you're running that money, that money is for a specific purpose. Unless the funder gives you permission, really you shouldn't be using it for anything else. Okay. Particularly with buildings, and I think this is a point where I was making, it is worth having, you know, a specific contingency, rolling refurbishment, all those things budgeted in advance. So planning what could go wrong, you know, and if you're thinking ahead, and this is a bit we're going to get into now, is actually moving from reactive financial managing to proactive financial management. You know, if you're actually thinking ahead, then that an amount for the ceiling falling in, you know, if it's a possibility, or at least some amount for repairs and to deal with contingencies and emergencies, should be, you know, something that you're looking at putting together, and then go into a funder maybe, and you know. So are we okay with that? Yeah. Okay. I'm gonna set us up on another slideshow now. Give us a moment. Okay. So won't be a second. Just need to swap presentations over. Brilliant. Okay, so we're looking now at taking control of your finances, okay, and starting to plan ahead. It's a lot of time and effort, okay, and particularly when you're a small organization, if you're trying to, you know, move move to become a larger organization, to become more stable, it can seem that the effort and the time outweighs the benefits. Okay. I put two words here: planning versus innovation. Sometimes as well, what we can find is that if we try and plan everything in detail down to the last thing, something happens and it throws all our plans out. And that's a balance as well. In the more detail we put into the planning, sometimes it just means we have to do work again and again, and it may actually take us in a direction that we don't want to go. Now, this is common to all organizations. And if we think of the organization on this graph here on the left, at startup, and then time moving from left to right, and on the graph going upwards, we've got how reactive the organization is. Think being entrepreneurial. Think the sort of organization that says, oh yeah, there's some funding over there. We need funding, let's get it. Okay. And then down at the bottom, we have how planned the organization is, how systems, policies and procedures are in place, how much budgeting is done, how much financial planning. What we tend to find in organizations, whether they're charities or whatever type of organization, is at the start, they'll do some planning. They'll put a business plan together, but really they won't know exactly what is going to happen. The plan to a large extent will be to get them off the ground, maybe to convince somebody to give them some funding at the start. As that organization then starts to exist, almost all organizations at startup are predominantly innovative. They're responding to things. It's a good thing almost. They're finding their feet as an organization. They're working out, you know, what type of funding can we apply for, what works. When we go and we talk to our service users, what services are they actually telling us they need? Okay, and so you have a little bit, quite a bit of change actually within the organization during that startup period. Now, there are some organizations, and I think we can see here along the top, that stay in that state. Okay, they don't do any planning really to speak of. They're being responsive. What funding is there out there? Okay, we'll chase that funding. And what they tend to do is they tend to end up getting pulled away from their core mission. They tend to have, oh, we're running out of money. We maybe got to lay some people off. Okay, but we'll survive. We'll get this funding from somewhere else. And so they move on from crisis to crisis. It's constant crisis management. And eventually they end up potentially failing, okay, as an organization. And this is a very, very common trajectory for startups. It's probably the most common trajectory for startups. If we look at the two lines, okay, think of the area in between. The area in between those two lines tends to be the area that successful organizations navigate, okay? They will do some planning, they will be innovative at start, but once they actually get going, they start to build structure. They start to get their financial planning systems properly in place. Now, if they go too far and they overplan, that actually can cause crises as well. They can end up, they've not responded to change. They've maybe got everything. So we're spending all this funding that's coming in, every penny is allocated. We don't have any free reserves. Everything's spoken for. And then they need some flexibility and they can't respond. So organizations tend to sort of meander between these two areas in this sort of shape. And what you're actually aiming for, I think as an organization, is over time is to avoid these crises and get to a period of stability where you are both planning and reactive. Yeah, you're planning, but within that planning process, you can respond to the changing environments out there, to new needs, to maybe things like COVID, that when, you know, maybe people start using a new drug, that you know that when a new problem starts to arise for your service users, you pick up on it, and that feeds into your planning processes. So the aim is to be both planning and innovating at the same time, if that makes sense. Yeah. Now, it's obviously, that's a theoretical thing. This is based on real research of organizations, and this tends to be the area in which organizations survive, or to be a long-term organization. Okay. Key thing that's going to help us do that is management information and the planning process. Okay. Now, management accounts, as I said previously, are different to financial accounts. Financial accounts are passed. We do them once a year. They are legislative. They're about compliance. Management accounts, making that distinction, past and future, it depends on the timescale, depends on what you're looking at. And basically, we use them to solve problems. Some of them will be regular. So our monthly management accounts are going to be designed to help us make day-to-day decisions. We might also conduct other types of management accounts, things like we might decide, we're going to analyze whether or not an investment is good. So things like investment appraisal, or we might decide to burrow down into an area of the budget to see exactly what's going on. So management accounts are a very flexible thing. We normally just tend to think of them as maybe our monthly, or every time the board meet, they get a set of management accounts and nobody else sees it. But actually, management accounts really should be designed for and used by the people making the relevant decisions. So if you have budget holders in the organization, people who set budgets, they should really be able to track those budgets. So management accounting is about supplying information, costing, budgeting, forecasting, putting together what-if scenarios, simulations, measuring performance, and deciding whether an investment's a good idea or not. Now, I can't take you in detail through all of these topics. Each one of these is probably an Open University course in itself. Yeah, each one is potentially quite detailed. But what we're aiming to do is just look at management accounting in the whole and how it all fits in. Okay. So there are routine sets of accounts, maybe monthly, maybe quarterly, and quite often there's something that we use called exception reporting. And what that basically means is we have triggers. We have if something goes further away from what was planned than a certain amount, quite often a percentage, then we will investigate further. And then there's non-routine stuff that will basically, we'll do that as we come across a problem, we'll actually use it to actually solve that problem. So this is just what management accounts entail. Now, whatever level in the organization you are, you might be recording information, processing it, presenting it, interpreting it, making decisions. But management accounts are designed for the people who are basically involved in any of the finance situations. So it is important that whatever management accounts are produced are in a form that is useful to the people using them and that they understand them. And so they may be looking at a smaller area rather than looking at the whole organization. sometimes management accounts given to maybe a department or a project. Maybe if somebody's actually in control of a project, maybe a drugs project, if that person, you know, is going to actually be able to adequately manage the finances there, then perhaps they should be having on a monthly basis a set of accounts which just focus on what they're looking at, just focus on that project. Now, generally at the higher levels, there'd be at least a balance sheet, income and expenditure. Normally for the current period, whether that's a month or a quarter, up to date in the year, compared to the annual budget, and a forecast for the end of the year. So basically, where are we? If things carry on as they are, what might happen at the end of the year? Okay. At a departmental level, so maybe the project, it would be that department's current year, what they're specifically going to end up with at the end of the year against budget, and then maybe break down that activity into different categories. That sort of makes sense, yeah. And it may even be that they have, we quite often with management accounts combine them maybe into things that involve other targets. So maybe how many young people have access to service. And that then gives the person running the project real good management information to say, is this going okay? Do we need to change something? Are we underspending? Are we overspending? Are we overspending but working with more young people than we anticipated? Are we well within budget, but maybe we're not delivering the objectives that we said we were going to? So at departmental level, that's the sort of thing that proves really useful. The non-routine stuff, there's all sorts, loads of these. I can't go into them, but sorts of things like cost analysis, working out where's our money going. If we are going, for example, to a funder, a classic example of this is, particularly if we want unrestricted funds and we don't want to be getting into constant, you know, the projects, and we want to buy you some laptops, but we've already got laptops. We want to buy you a printer. We've already got printer. Funders do like to buy items. And if we actually can, for example, an example of a non-routine management accounts exercise would be to calculate the unit cost of supporting one individual. And then you can go to your funders and say, well, to house one young person for 12 months costs this much. Can you support 5? Yeah. And so that would be an example of a management accounting exercise being used in a fundraising context. So non-routine accounts, financial analysis, management accounts are just so varied. Yeah. So it's quite a catch-all phrase. We can look at the life cycle costs of things. We might actually go into then looking at capital budgeting and maybe putting in place a long-term budget for renovation repair, maybe a contingency budget. So all of these exercises of management accountants, even setting a budget is technically management accounts. Okay. I'm just going to say, etc., etc. There are loads and loads and loads of things. Now, if you have a good accountant, they may be able to sort of like to produce some of these things for you on an ad hoc basis. Okay. If you have a finance officer and you get them trained up, they should be able to do a lot of these things in-house themselves. Managers as well. You know, if you do an advanced management course, you'll be covering this sort of thing. And it is a really, really useful ability to have within your organization. Okay. The most obvious set of management or process in management accounting that people think of is budgeting. Okay. And so when we start looking at budgets, all the budget is, it's a plan to allocate resources and predict outcomes, and it is quantified. And if we go back to that very first slide, we're using money as the quantity to compare different things. So it's not just about what's coming in and out of the bank account, particularly in charities. It's about what activities can we actually undertake, okay? And how does that relate to staff costs? How does that relate to resource costs? And the cycle should be pretty much ongoing with budgets. We should be forecasting our income, planning our activity, setting budgets, monitoring, reviewing, and forecasting again. And this is key really to stopping being that reactive organization and actually starting to take control of your finances. Typically, if I was running an organization, typically about 6 months before the new financial year started, I would already have a fundraising forecast. I'd have a list of all the funders that I'd approached or was planning on approaching, or I thought might come in the following year. I'd have that list. I'd have worked out some things off my wish list, things that I'd want to actually achieve in the following year. And I'd be looking at which ones I knew were going to come in, which ones I expected to come in, which ones were total, we're totally sort of like, well, a cold call, basically. We have no idea. We've never worked with this funder before, but let's give it a go. And very conservatively, I would be looking at what we brought in the previous year and saying, okay, in the region of so much is what we might expect to come in. Okay. I'd then be going, but what do we know is definitely coming in? And that would be a much lower figure. Okay. And I would be then saying, okay, let's plan 2 scenarios. Let's plan a scenario where we only get in what we actually know for definite we've got in. And then let's plan a scenario where we get everything. And we could maybe even divide that into projects and say, well, okay, we want to get the National Lottery Reaching Communities bid for work with homeless. So that we'll do a budget for that, and we'll do an activity plan for it. That is going to sit there, but it isn't in our main budget unless we get that money. Okay. And so we build maybe a series of budgets, one master budget based on what we know is coming in, and then things that if they do come in, we'd like to do if we get that money. Okay. And then when the financial year actually starts, okay, these are our budgets. Okay. Based on what at this point now, as more incomes come in, this is what we know. This is now what we're working for. And then throughout the year, we keep monitoring that. And if we have a ceiling fall in and we have to replan part of the budget, or if we get another major donation come in, again, we sort of like we monitor, we review, we may even revise the income forecast. And we may even redo the budgets at the 6-month period. Okay. So we're constantly engaged in this cycle. It's not just a case of we set budgets and then at the end of the day, we look at it and see how did we do. It should be an ongoing cycle. And I think the other key thing is who is involved in the budgeting process within your organization. And this is, different organizations have different cultures. Something that I have found organizations do find incredibly useful is to actually involve people throughout the organization, the people who are spending the money in the budgeting process. Okay. And that might be as simple as having maybe somebody working in the office, and at the start of the budgeting process, say, okay, what do you want that would make your life easier? Yeah. Oh, this photocopy is always breaking down. Okay, we'll put that in as into our wish list. You know, and it could be as simple as involving them at that level, right the way through to having somebody maybe who's going to be running a project say, okay, I'd like you to actually put together a budget for this under these headings, which is brilliant because it actually develops the skills of that member of staff. So I do like to involve in organisations rather than it just being a top-down thing. I do think organisations benefit from making that process involve more than just a very senior management team. Okay. So if you just give me a second, I'm just going to quickly look here and see. At the minute, I can't see the chat and I can't hear your voices. So is that all making sense so far? Anybody got any questions on that bit? Yeah. Okay, that's fine. I just wanted to check in with you because I was missing you. I'll go back into the slideshow now then.
Lee, can you hear me?
I can, yes.
Do you want me to read out some of the questions?
If you could, yeah, that'd be brilliant.
Okay, so Penny says, how can restricted funds be carried forward for use in the following financial year?
Okay. Yeah, well, we sort of touched on, I mean, obviously restricted funds can't be used for another purpose. In terms of carrying them forward to use in the following financial year, it depends on the agreed term of those funds. Normally restricted funds have to be spent by a certain time. If they're completely open-ended, then there wouldn't be a problem as long as eventually they were spent. But again, I think what I alluded to earlier was quite often you do end up where a funder actually makes a donation and it's, you know, let's say, for example, reaching communities and it's 2-year funding and funding needs to be spent between January to December, but your financial year actually runs April to April. And so basically you just need to track it through each of the financial years and make sure that you are meeting the funders. So quite often restricted fundings do carry forward into the following financial year in terms of your financial year, because your financial year is not always the same as the funders or the projects. Does that make sense?
Yep, I think that sounds good.
Yeah. Yeah.
The other questions were just about sending the slides around and things like that, so that's fine.
That's brilliant then. So if nobody else is urgently wanting a question, I'll go back to the presentation. And this goes back to, I think, a question that was asked about budgeting. Cost centers and revenue centers. Yeah. Cost centers can be done in a couple of different ways. Cost centers, again, just as a reminder, are that list of items that you're going to allocate to budget headings. So we're going to spend so much money on staff, national insurance. We're going to have office costs, photocopy, printer costs, postage costs, stationery, blah, 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 all down the list, vehicle costs. Maybe then we're going to have specific project costs. So maybe the drugs project, because that's restricted funding, we're going to have that as a separate item, its own heading. And that's really something that you as an organization need to decide. And that may change, you know, as you develop and as your organization changes. There are two ways of basically doing that. You can do it based on location and do it based on activity. So putting it very, very simply, it may be that if you've got 2 offices, each one has a budget, and then you might have a central admin budget that might be actually split across both sites, but you separate out that function. So you've got there a mix of geographical and functional costing. And again, that's for each organisation really to decide what works for them. Revenue centres, I have always found it useful to separate out different funding types, particularly corporate, particularly trust funds, as opposed to government funding, local government funding. And I think another of the interesting things there, just from experience, is that government funding is very much dependent on the policy of the day. And funding programs can suddenly be withdrawn, you know, sort of like going back to this concentration thing. We don't want to put all our eggs in one basket. So actually separating out our revenue centres, where the money's coming from, helps us work out whether we have a broad enough concentration, i.e. we're not putting all our eggs in one basket. We need to understand, and I think I mentioned earlier, that not all costs just go up. You get one extra person walk through the door and suddenly your staff ratios change and you need to bring in another member of staff. And so whereas up until that point, any new person coming in, you could say, oh yeah, it's going to be, to support this person is going to be £3,000 a year. Yeah. And that works up to 100 people. And then you get to 101 and suddenly everything doubles. And that 101st person might actually cost you half as much as all the people you've been supporting up to that point. Costs step, they're variable, semi-variable and mixed. We talked a little bit about apportioning overheads, direct and indirect costs. Direct costs is any cost that you can attribute to whatever it is you are achieving. So if you were making hamburgers, it would be the cost of the cheese and the bun and the meat. Working, I suppose, with service users, direct costs tend to be, this is money we've spent delivering some form of intervention or support for the service user. Indirect costs tend to be the ones which are just there, that you couldn't attribute to one individual user. And overheads then sort of include those indirect costs and then some overarching costs. So again, I don't want to go too much into the precise things, but just understanding what some of these words mean in general, I think will probably help you having conversations with other people. We've talked about apportioning, which is spreading the cost into different areas, maybe by throughput or by land usage or room usage. What I'd actually like you to do is get on with a budget exercise, okay? And I think what we will do, if I can come back now into being able to see you, give me a second. There we go. What I'd like us to do is probably either use voice or Toby, if you could, any stuff that comes out on the text, if you could shout it out to me. What I'd like us to do is invent a service user. So if we, could somebody just give me a name, a random name, anybody?
Name of what exactly?
Just a name of a person, any person. This is a fictional person, so just a first name.
Brian.
Brian. Okay, so Brian is going to be. So, how old is Brian? Somebody tell me. Give me an age for Brian.
39.
Is that 21?
39.
39.
39. Okay, Brian's 39. Okay. Where does he live?
10 miles away.
Okay, is that in a flat or is that in a house or is that in a...
If it's a flat, what does it make a difference?
Okay. It might do. Might do. Let's see.
Okay.
So he's living in a flat. Okay. Does he have any pets?
Cat.
A cat? Relatives. Has he got any relatives?
Yes, but they live out, like outside,
Far.
far away here.
Sorry, I just made the volume was very low on that one.
Far away.
So relatives are all far away. Okay. What about friends?
Yeah, couple of friends.
Couple of friends, same age?
Maybe one older, one same age.
Okay. Does he have a girlfriend or a boyfriend?
Yeah, that's another cost. Yeah.
Okay, so he has got somebody who he goes out to meet, maybe doesn't live with him, but he goes out to meet them occasionally.
Definitely.
Maybe have a drink when there aren't restrictions on and he can actually
Yeah.
Okay. Does he have a job?
That's a question. In these days, it's very hard to have a job.
Well, what let's say, Brian, are we going to let him have a job or are we going to say he's unemployed or
Recently got unemployed.
he's unemployed?
Just
We
got
could
in
maybe say
unemployed.
worked in a shop and has become unemployed.
So what we're going to do then is we're going to just open up a little exercise. I would have done this in breakout rooms, but since I'm struggling a bit with the IT today, for which I do apologize, I'm going to do this on screen and we'll do it as a group.
It's better. Okay.
So give me a moment. Okay, so here we have a little exercise. So did we say that he was unemployed? Was that right? Toby said something I didn't quite catch.
Yeah. I said he worked in a shop, but he recently became unemployed.
Okay, so he used to work in a shop. Okay, and when he worked in the shop, he actually had he bought a television on HP, and that is costing him that's costing him £10 a month. Okay, so if you see what I'm actually doing here,
Yeah.
okay. So what money has he got coming in?
Universal credit.
So universal credit. Go on, what's he getting a week?
Oh, I hate to think how.
Do it monthly now, don't they? Yeah.
£600 a month.
£600 a month. That must be London prices, that.
It's not that. That's much less. But
Yeah. We'll say anything else that's coming in. Now, of course, his universal credit has got to cover his rent, hasn't it? So what's the average rent down your way a month?
about £1,000 for a studio flat a month.
How much?
£1,000.
Oh my God.
So straight away, he's not going to be able to afford that unless he's got any more coming in off universal credit, is he? Because universal credit covers housing benefit now, doesn't it?
Yeah, this is the problem for a lot of people. And the benefit cap. But anyway, we won't get into that. Maybe we could say his rent is 400 a month.
It's amazing, isn't it, that we're doing it just as an exercise, and it's just so obvious that it's not going to work for a lot of people.
Yeah.
Sorry, that's I'll not get on my soapbox. Okay, council tax. Does he pay that out of universal credit?
You get a discount, but you still have to pay it separately. Yeah.
Yeah. So what do you reckon he's going to be discounted?
£20 a month.
£20 a month. Okay. Just looking at that 400. You know, I wish somewhere around here I could get for £400, and we're up north. So council tax. What else has he got to spend money on?
Food.
He's got a cat. So, well, food first of all.
Yeah.
So what's he spending on food?
If it's £30 a week.
So £30 a week, maybe. And we could run through this, that we could cover cat food, we could cover vet bills and things like that.
Yeah.
And some of these costs are maybe gonna change. Okay.
Yeah.
And he might actually manage to balance it all at the end of the year. I think he's going to struggle to. So this is basically, these are our income.
Lee, it's £30 for a week, so it has to be more than that for a month.
Sorry, £30. Yeah, £30 a week, isn't it? So it's £30 a week. And then what we would do here is we would times 4.2, and that would be somewhere
360.
There we go. Apologies for that. So yeah, so he's already running low, isn't he? But then suddenly his cat has his cat gets ill, and he needs to pay vet bills on the cat, or maybe one of his long lost relatives suddenly appears and says, hiya Brian, I'm coming staying with you for a couple of weeks. Yeah. And doesn't bring any money into the house, but suddenly it's starting to and these are the sort of things that happen in real life, aren't they? Yeah.
True, that's true.
And it's the same for organizations. I know this is a really, really simple example, and we could get into things that were costs that behave differently. Yeah. I'm looking at the time, and I could spend half a day looking at cost behavior on here. But this is the thing with budgets, is unexpected things happen.
Yeah.
And this is why we aim to have reserves and try and plan as much as we can, but still be responsive. So if I just go back to, if you give me a moment. If we just very quickly go back to the presentation. Let's actually look at Generico again, generic aid. Let's have a look at a little bit more in-depth budget now, or rather set of management accounts. Okay, now remember, management accounts are based on budgets, and in this instance, can everybody see the screen here? We have a set of management accounts for generic aid. Okay, now this is following on from the previous year. Okay, and we look here that they have got some income headings, and at some point somebody has sat down and has put together a budget. So we can see here in the column that says budget, we can see a list of numbers, and that was what was planned. Okay. And we've divided its income, trust funding, some income from housing. So they must have some housing that they let out, or they get some form of income there. They have a shop. They've been putting events on, some individual donors, there's some investments, and then some other income. Okay. And then we see restricted grant income, music for all. Okay, so this is obviously a music project that they were planning on running. And this is probably the restricted fund that they hadn't spent the previous year. As we go down, we find that the expenditure, materials, salaries, premises, marketing, vehicle, unrestricted, and they've separated out, they've done well here, they've separated out the restricted project, which probably somewhere else has its own full budget breakdown. But in these accounts that we're looking at, it's only showing the total figure for the restricted project. Okay. We've got an additional column for general overheads, which is probably because they have an office which they get support from, which is somewhere else. And then total, and then we've got surplus deficits. Is this all making sense so far? Can you see when I move the cursor around? Can you see it?
Yes. Can I ask a question?
Yes. Go ahead.
Okay. We have this management accounts up to 31st of December. So the first column is the current period, which the actual budget and the variance.
That's right. So what it says is where the
second one also says year to date.
Right. So let me just explain that. Yeah, this is for the financial year that ends on the 30th of March,
yes.
2020. So over the top right hand side, that tells us when the year ends.
Yeah, I noticed that.
Period 9 means this is month 9. So
yes.
This is then saying that this is the month up to the end of December. Yeah. And it's saying for that month, current period 9. Yeah.
Yes.
We've got actual budget, and then we've got how far or how close we were to that budget.
I understand the first. Yeah.
We've then got every month, including month 9. So that would be April, May, June, July, August, September, October, November, December, all added together in the next column.
But then how can you have actual when you haven't yet spent it?
Well, because this is actual. So basically, this is a time snap. This is a shot in time.
Yes.
Taken at the 31st of December.
Yes, but your second column, which is saying year to date,
is from the beginning of the year
to the 31st of March.
No, to December.
But the actually is different.
So the first lot is from the beginning of December to the end of December. So it's just the month of December.
All right. Yes, I understand. Yes.
Yeah. So current period, these are monthly management accounts. Now, if it was quarterly, that current period might be 3 months.
Yes.
But in this instance, it's 1 month. So you've got the 1 month snapshot, and that's useful for managers and for the organization because it tells you what's gone on recently.
Yes.
You've then got year to date, which is how are we progressing against where we should be at this point? Yeah.
I understand.
What are we aiming to end up with, or what were we planning to end up with? And then that projection is, all right, what are we likely to get to? Yeah. Now that projection is something that, the calculation, your accountant probably will do that. The simplest way of doing it is to actually look at where you are at the moment and say, well, if we're spending this every month, where is it going to end up? So it might take a little bit of digging into the accounts to make the projection and looking, has there been a one-off expenditure? somewhere in the month, or are we actually running over every month?
The projection compares to the budget?
So the projection, yeah, is compared to the annual budget.
Budget, yeah. Okay, yes.
So, and this is the thing, I think sometimes when we look at this, this is a fairly typical set of management accounts. Sometimes they're displayed in slightly different ways, but they generally have this sort of format. And what I'm hoping is that this session will stop you just seeing a sea of numbers and actually help you understand what's going on inside those numbers. Does that make sense? Yeah.
Yes.
So in this particular format, we've got current period, which is the month of December. Year to date is April to December. Annual budget is April to April. And then the projection is where we think they might end up at the end of the year. And being as this is December, there's only a few months to the year end. This projection should be fairly accurate. So again, I'm going to let you have a little look at this. And
can I just ask about the figures in red?
The figures in red, if we go back to this morning, that means they're minus. So remember I said there's a number of different ways we can display negative figures in accounts. One is we put the minus sign. The other is we colour them red. And the other one, which basically dates back to the days before we had colour printers, is we put them in brackets. That made stuff so hard to read. This variance column, yeah, this variance is how much the actual is to the budget. So that ends up being in red if, when it's income, yeah, we've spent less than the budget. But if we go down to expenditure, it's red. Sorry, so it's in the income period, yeah, if the income is less than the budget, it's in red. Yeah. But if we go down to the expenditure, if we've spent more than we budgeted, that's in red. So the red basically means it's the wrong way. We don't want it to be in that direction. It's basically, it's unfavorable. Does that make sense?
Yes.
Yeah, it's adverse. So anything that appears straight away when you look at the figures, is there anything that you can actually interpret from that before I go any further? As we're looking, housing income is less. Okay, and on the year, they're actually looking at the end, the projection is that although they're going to be up on trust funding, because that's done better, housing income is going to be under. So maybe they've had low occupancy, but that's low. The shop is doing okay. That's doing better than normal. Individual donors, oh, they've not done so well there. So basically they're looking at maybe only getting £5,000 in from individual donors, and their plan was 15,000. So that's a big underperformance there. I wonder why that might have happened. What can they learn from that? What could they put right? Investments they're on track. Other income's on track. Okay. In total, when they look at it, the unrestricted income, actually, the trust funding has sort of made up for the deficits elsewhere, and they're only, you know, they're only a small amount of money below their projection. They're looking at the projection is going to be only a small amount of money below their budget. And annual budget for the Music for All project. Okay, again, that's annual budget 30,000, projection 30,000. So that's looking okay, isn't it, as well? Okay, in terms of, so they've got the money in that they anticipated getting in. They're only, what, £2,500 below their budgeted income. So the fundraising department's done all right there. We can maybe ask a question, why have we not got so much for the individual donors? Then if we go down into expenditure, okay, well, they've overspent on materials, quite a bit, actually. Salaries, fine. Premises, actual budget, well, they're looking at an overspend on their budget. But that's actually something that's, I think, happened earlier in the year. Because in the year to date, that's where the figures are looking different, £5,000 on premises. That was possibly, maybe they had a ceiling collapse, or maybe they had some repairs or found asbestos or something like that. Marketing, they've spent less than they should have done. Okay. And it's looking like the marketing budget, the marketing budget's going to be over. Sorry, the marketing budget's going to be over at the year end. So it's quite a complex picture there. And then the music project, is only projected to have spent 5,000 at the end of this year, even though the budget was 30,000. Okay. So what we've ended up with there is we've got this restricted project again causing problems. Okay. If we look at overheads are slightly higher. Total expenditure is under though. Overall, the expenditure is under, and their surplus on the very bottom row, the bottom line as we call it, they expected a surplus of 40,000, and it's 47,000. So actually they can give themselves a pat on the back, can they? Or is there a problem lurking in amongst all that?
But at the end of the day, they are in deficit because total expenditure is more than the, oh no, sorry, that's the surplus, yeah.
Now look, we're not running this company. We don't know a lot about it. I'm just going to stop sharing for a second because I want to look at faces, and just see, when you look through that, was it as much as anything, what I want to do is to get you being able to look and actually understand what they mean, the different columns, okay, and where the information is held. There's all sorts you can start to draw out of that. You could start to look at, for example, the obvious one would be the unrestricted project, but you might also say, well, when we look at our fundraising, these individual donors or the events or whatever, if there's any underperformance there, where's it come from? But you know what, when you look at a set of figures, even as a trustee or as a senior manager, sometimes it's just a jumble of numbers. You can understand the columns, but how do you filter out the bits that are important? Okay. And this is something that it's one of the most simple techniques that we can use when we start looking at figures, and it's called exception reporting. Okay. And what we basically do is we say, and I'm going to go back to the screen again. We go back to the screen, and we say everything which is a variance of more than 10%, whether it's up or down, is something to look at. So any of these figures which is more than 10, probably needs investigating, because what it means is we are more than 10% away from what the original plan was. Now, there might be an absolutely wonderful explanation for it, but you as a manager running a project, if you get a set of figures, and, you know, I would say if you're getting unprepared, ask to have a variance calculated for you, because it saves you doing it. Otherwise, you know, I found myself in a situation where I've been given sets of figures, and the first thing I've done with them is I've put them into Excel and I've calculated the variance for myself. The actual amount of the variance can be important if it's a huge amount, but perhaps the biggest indicator is the percentage. So trust funding, housing income, that's probably at the limit on the month, in terms of 10%. Trust funding 8%, and it's to the, so I'm probably not going to make a big deal about that. But the housing income, that 20% deficit on the year to date, so 20% difference on the year to date, I'm going to be asking questions over that as a manager. I'm going to, you know, what's going on here? And that's my early warning system. That's what stops the project getting out of hand. The shop 11%. Yeah, I'm gonna keep an eye on that. I'm gonna have a word about it maybe. Individual donors, we are a long way down there, in terms of individual donors. Hi, are you okay? So,
I think Gary's not on mute.
Was somebody asking a question? Okay, so individual donors, that's a big one. Yes.
There's a couple of questions in the chat. Shall I read them out to you?
Yes, if you would, that'd be brilliant. Thank you, Toby.
So Penny says, if a project underspends because of donated goods or expert time, can the resulting restricted fund surplus be used elsewhere?
Sorry, could you just repeat the question again? So
if a project underspends because of donated goods or expert time, can this restricted fund surplus be used elsewhere?
Right. Now, sometimes we do get donated goods. Okay. Effectively, that becomes match funding. Okay. I would say, if in doubt, always chat to the funder. If there's ever a question like that arises, your safest bet is to have a word with the funder. Technically, it's the money and the activity. Okay. So I would say talk to the funder on that one.
Okay.
I've
got a question from Margaret. Interesting question. If your organisation is expecting money but has not received it, how do you present it?
Right. Okay. If you are using now, if it's expected within the financial year, then in your financial accounts, yeah, or if you're using accruals, then you would actually count it as arrived, but that doesn't mean it's necessarily there for cash flow. So many organizations will, as well as having a set of management accounts like this, also have a cash flow. Does that make sense? Yeah. So they will basically have they'll have something which looks at the actual money in the account as well. Okay, that is less important when you've got reserves, when you've got some money in. But for very, very small organizations, you know, where maybe at the end of every month you've got £500 in the account, the cash flow management is important. So it might be that is normally we would count money at the moment that it is either committed So the minute you sign the contract, have the building work done, even though the building work hasn't been done yet, and you might not have written the check. Yeah. But the minute it becomes a contractual obligation, and then in the opposite direction, if you have an absolute cast iron guarantee of money coming in, and I would be very cautious on that, because it's always better to err on the side of caution. But you know, if you've had a formal letter saying that money is awarded, and it's a written agreement, you know, lottery funding, it's on its way to you, that's the point at which you'd start recording that as income. Again, does that make sense? And that's based on this accruals principle that we had that we mentioned this morning.
Yep, that sounds great. I often get confused with things like what Margaret said about, are you actually reflecting what's in your bank and in this sort of thing? But I think you've made it clear the difference, that if you know the money is expected and you've got some sort of concrete evidence that it is coming, then you can show it in these sorts of things. So I think that was a good example, a good question that Margaret asked there.
Very good question. And these are the areas that are tricky. The thing is, when we do our, you know, when I look at my bank account, and I check the balance, I'm looking at what the balance is. Yeah. And sometimes when the bank says, but your available balance is, the question, oh, well, what's that then? And because instinctively we operate on the same basis as our household or our personal accounts. When we run in an organization, this accruals thing does seem sometimes a little bit counterintuitive, because, oh, well, we've not actually got the money yet. We can't spend it until we've actually got it. But by the same token, if you've committed to spending something, that's the balance on the other side of it. Again, if that makes sense. Okay, any other questions, Toby?
No, that's it.
That's
on
it.
the chat.
Okay, so so we were looking at we were looking at anything above, anything in this variance percent column, which is more than 10%, is something that, and it's your quickest way of looking through this. If they're all really low, then the organization is probably fine. If, like this one, they're all quite high, there's probably something underlying. Either the budget wasn't set properly in the first place, and that can happen. That's quite common, and it doesn't necessarily mean it doesn't always mean there's something wrong with the organization. It could just be that this is a new project of a type that they've not run before, and so the budget was pretty much stick the finger in the air, and that happens. Yeah. It's much better if research is done a lot deeper. It could be that there has been a major change within the year. It could be, for example, you know, something like C9, you know, COVID, or something else, a major change, which has affected what's going on. So there could be any number of reasons. Either the budget has changed, or you know, or maybe maybe a senior manager's left, or the person running the project's left, and so it isn't necessarily this is a major problem with these numbers, but we certainly need to get a hold of them as quick as we can. And looking at this, we've got a quarter in which to do it, and some of these we're going to struggle. So we may even be looking at things and saying, you know what, if I was here now and I'm looking at this restricted grant, we've actually put it in as income this year. Now, if half of the project was supposed to be in this financial year and half in next financial year, then really we should have only recorded half of that income in this year. So that's the other side of accruals. You know, if it's a pot of money to spread over 2 years, we should only put the bit that's relevant to this year in this year. We haven't spent it. We might be able to catch it up if there is any money for next year. But certainly at this point, with a quarter to go, I'd be going, you know what, I need to have words with this. I need to have words with this funder and warn them, because at least if I've warned them, they can't say that. You know, they can't say that I haven't. I've been open with them, and they're more likely to be good with us. And what we need to do is we need to really grab hold of this now. Again, it could be that the project is for a big event. It could be a music for all. Could be a music festival that happens in January. So that might be explainable, but I definitely, as a manager, I'd want to know about that. And then going down into the expenditure, why are we spending too much on materials? What's happened with premises? Because you know, that could be a one-off. That could be a trend that causes a problem. And our overheads. And in terms of our operating surplus, it's actually showing that we're projected to be 47, so above our budget. But if we lose that 30,000 music for all, then we could end up actually below our budget. So looking at a set of management accounts like that can give you all sorts of information. This variance analysis is the key thing, really. 10% is usually what we use as a threshold, but depending, it may be set as low as 5%. Yeah, you decide that as your organisation where your tolerance of, you know, if it's a brand new project, you might say, okay, we'll allow 15% because this is something we've not run before, and we really don't know what cost. But then next year we learn from it, yeah, and we use the previous year's budgets to help set the new year's. There are other reporting formats, graphs, key performance indicators, balance scorecards, spreadsheets, and cash flows. Cash flows was the one that we were talking about, which would show what's in the bank. Spreadsheets. Spreadsheets, a variety of different formats to produce different things. Graphs can be very good in giving a quick picture. You know, are things trending up or down? Balance scorecards and key performance indicators are quite interesting, really. Key performance indicators tend to be linked to strategic goals and tend to include not just financial measures, but other measures. So I remember I said earlier that sometimes management information, management accounts might actually be linked to another set of figures, which are maybe throughput or outcomes, people placed into jobs, or people, you know, people actually finding a home. So the key performance indicators might include that. It could also include things like applicants for help, percentage receiving follow-up within 5 days. Yeah. Anything which is related to strategic goals can be put into key performance indicators, and balance scorecards are quite often, they're another way of expressing that. Key performance indicators and balance scorecards are actually part of a set of tools developed by Kaplan and Norton, along with strategy maps, which is the third part of the thing. When you look at these, what you might see is you quite often, I think people see, they'll see happy faces and then maybe an arrow going up or down, and maybe the face is coloured in red or green. And we quite often see these in higher level accounts because it's an at a glance, and it's letting you know effectively, is this going in the right direction? When we're doing management accounts, any of this information, and I say this is we've only really just touched the surface of it, make sure it's tactful. It needs to be on time. It needs, i.e. soon enough after the financial period in question that you can actively make decisions. It needs to be accurate enough for decisions to be made. It needs to be complete enough, And it also needs to be traceable. So if you detect a problem, you need to be able to go, okay, let's burrow into this further.
Can I ask a question?
Yes, go ahead.
Would you suggest a program or accounting program or something that is like more simpler version?
I think, to be honest, with your financial accounts and your daily recording of income and expenditure, if you have any, well, I think the minute that you move on to payroll, to actually employing people, really these days you're going to really struggle without either Sage or QuickBooks or an accounting package like that. They will then produce some of the raw data for you to be able to produce management accounts. Your accountant should be able to. Now, he might charge you a bit extra. If so, generally when you go to an accountant, they'll quote you a fee, get them to determine what they're going to provide for that. Yeah, because again, I've come across accountancies that have said, okay, yeah, this is what it's going to be a month, and all the client has received is a set of annual accounts at the end of the year. And then other organizations where the accountant has said, okay, this is what we will deliver for you. We will provide QuickBooks. We'll set it up on your system. We'll have somebody come and deliver some training for you, okay, to make sure you can use it. And somebody will come down once a month, before we submit the accounts, just to check everything's been done okay. We'll then produce every month, we'll produce a set of management accounts to this format for your board, and then we'll produce your annual accounts. And in those, and actually the accountant that offered all that was cheaper than the other accountant. So pin down with your accountant what they're actually going to provide for you. It is really, really useful if your accountant is going to be able to interrogate whatever accounts package you're using and produce a set of management accounts for you either every month or every quarter as required. If not, then it's going to be something that's going to have to be a DIY job, really. And, much as this is, I'm giving you an overview here, I can't really, within the space of today, teach you how to set up the formulas in Excel to run specific queries. And there's so much of it, things like investment appraisals and things like that. I think what you're doing at that point is either going to your accountant and saying, look, could you help us with this? We want to answer this question. Or actually finding somebody within the organization or as a consultant or something like that, who you can bring in to say, look, this is a specific project, or we want to start doing this on a regular basis to produce those figures. Does that make sense?
Yes, thank you.
Yeah.
Hello. Well, can I ask a question? A very quick question. The management report you presented, can that be extracted from QuickBooks? The exact format.
In that exact format,
yes.
No.
Okay, fine. That's fine.
Okay. However, okay, QuickBooks will give you you can run reports on QuickBooks, and how you set them up, those reports, okay, is what you will get. Now, I'm pretty sure that when the accountant runs QuickBooks, yeah, he extracts the information and it slots into a spreadsheet and he sends it off to you, and it takes him no time at all. But if you were just sat there on your own with it, I don't think you're going to be able to extract that and put it into exactly that format. All
right. Yeah, I thought that it was exported into Excel. By doing that, if you export the information into Excel and then you can format it to your liking.
Yeah, I mean, again, if you have an accountant and or if you're extracting the raw data out, putting it into a format that works for you is really important.
Yes.
So I've only shown you one format, okay? There's a number of different formats. I think it's important to be able to compare the month or the accounting period, that month. I think it's important to be able to compare where you are progress to date, okay? Sometimes, particularly in retail, because it's seasonal, or if maybe there's, you know, if you're in anything that's seasonal, then it may be that you want to compare against the previous year, and then your forecast at the end. So really, it needs to be designed around your needs as an organisation. Okay. It also needs to be something as well where the figures don't dance around. You know, it needs to be clear. I once, and again, this is I once was working for an organisation. I put in place their finance systems, and we had all these complex spreadsheets, which were really, and there was a lot of financial experience within the board. But what I'd failed to take into account was I was a lot younger then. They were about the age I am now, and they couldn't see half the figures because of their eyesight. You know, they were peering at times. So we need to make things work for the organisation. Does that make sense? And the people who are using it. And particularly if it's more junior staff that you're involving in the process, simplification might be the way forward, presenting the relevant information rather than everything. Okay, we are nearly there, guys. I'm just going to go back to the screen. And say, if it's going to work, your management accounts, it needs to be in a form that the user can interpret. It needs to be understandable. It needs to be able to be compared with the other organizations' timescales or scenarios that are relevant. Hopefully it will show up trends as well as problems. And it needs to be more benefit than the effort to create it. Okay. So, you know, spending all your time pulling out the figures, if you can get your accountant or some form of machinery software to do that, then that's so much better, because you don't want to be falling into that dip. If you remember the planning versus emergent stuff, where you end up spending all your time planning and not actually doing. So it needs, the benefit needs to exceed the effort to create. Okay. When it comes to controlling budgets, do think how you can actually control those once you've spotted the problems. What means do you have of ensuring that you can take control of them again? Okay, you need to find the sweet spot between balancing the books and achieving social purpose. I think that's another really key thing as an organization. You know, you exist not to make the accountant happy, although you need to be legal, you need to do things right, keep the funders happy, but you primarily exist not necessarily to build your surpluses and huge reserves. It's about delivering the goods. And the main reason that we're looking at a lot of this is to make sure you do that in the long term, that it's sustainable, and that it makes you resilient as an organization, and you can deal with problems and crises when they arrive. So it's about finding that sweet spot between finances and social purpose. When you're looking at any of this financial information, let's say you'd done an investment appraisal and it had demonstrated to you that it was actually cheaper over a 10-year period to buy rather than to lease a vehicle. But then you might actually look and say, yeah, but our funding, the funding where we're going to use it is only actually 2 years. And we might end up with a bit of a white elephant here. We might end up with something that so it might actually make more sense from a strategic point of view for you actually to say, no, we're gonna actually lease it, even though it's a little bit more expensive. So it is weighing up costs against benefits. It's about optimizing the cost benefits. Management accounts are very, very useful for building in improvements. Do review, learn, apply, and also for drilling down into things, locating a problem and then investigating. So, you know, why aren't people using our service? Chances are you'll pick that up actually in the finances, because things aren't being spent or whatever. Probably even potentially before you actually notice that, from the numbers of people walking in through the door. So management accounts, the finance is only part of the story. The strategic and the operational, sort of like linkages to good financial systems and processes, can't be underestimated. Okay, so at that point, I hope I hit the brief. I hope that the impact of the problems I had with IT earlier weren't too serious. It's a long time to be talking. So I hope it helped you. You know, certainly, I mean, I can have a word with Toby afterwards. Has anybody got any final questions or comments or anything like that?
I think someone has a question about the difference between deferred and accrual income.
Right. So did you say it again, Ian?
I think someone had a question about the difference between deferred and accrued income.
Right. So deferred and accrued. It's I mean, at this level, you know, sort of like when we accrue stuff, okay, it's money that we're saying this is, you know, this is sort of like we're putting it into the accounts. We're recording it at the time that it is actually sort of like commissioned. Okay. Now sometimes we can actually choose. Okay, we should say, okay, we're gonna defer that to another part of the year. In terms of this level, I think we're in danger there of probably splitting hairs a bit too much between them, if that makes sense. There's a lot of similarities there. I think the key thing I wanted to get over there was the fact that we record stuff when it is commissioned. We do have some flexibility in terms of deferring stuff to a different period, but I think the key point I wanted to get over without muddying the waters was about actually, you know, accruing. Does that make sense? Yeah.
So Lee, I just wanted to say that I found it, I don't know about everyone else, but while I'm reading some of the chat, lots of people saying they found it really useful. I, for one, found it really useful. I found it just pitched at the right level, and yeah, I thought it was very helpful. So thank you very much. And I'm just going to remind everyone that I've just sent an email out to everyone with a very quick survey, so you can give some feedback on your thoughts regarding today's training. And also there's a link to other training that we're providing. So if you enjoyed it today, please do click on the link and you can see all the other training sessions we've got planned. But yeah, are there any other questions for Lee before we close for today? And Lee will be giving me his slides, and yes, we've recorded this, so I'll edit it a bit, and I'll be sending that out in the next couple of days. But any other questions before we close?
Yes, and any document, anything as an evidence that I have attended the course. Will we be getting an evidence that I actually attended or listened or participated in the course?
Sorry.
No, say I'm not aware of that. I was just going to pass it over to you, Toby. That one, I don't know whether direct social change has agreed anything with you.
Like accredited learning, so we don't actually issue certificates and things like that. But if you need to tell someone, I can send you email saying you attended this, but it isn't actually accredited, so we don't actually give out certificates and things like that. Any other questions?
Just wanted to say, Lee, it was an amazing session. You've covered everything in such a short span of time, and you have made it so simple. So
well, thank you, Vincent. I hope, I'd say we did cover a lot of ground there, didn't we?
And you did it within 2.5 or whatever hours you had with the technical challenges.
Yeah.
So amazing. Thank you. And thank you, Toby and Ian, for arranging this session as well.
Oh, it's our pleasure. Thanks for attending today.
Okay.
Yeah, thank you. Thank you, Lee. It was
Thank you.
wonderful.
Well, thank you.
And
Thank you
helpful
all for
small
having me.
organizations.
Yeah.
Yeah. Thank you.
Thank you very much.
Brilliant.
Thank you very much.
Bye.
Bye.
Thank you. Bye-bye.
Thank you. Bye-bye.
Thank you.
Thank you very much. Bye.